The Rebel Capitalist Show.
I've heard you talk about being in kind of the disinflation camp, and correct me if I'm wrong there. So it's just you believe that we're going to continue to see prices increase, but just at lower levels because potentially we're going, or there's a high probability that we're going into an economic recession in the United States, and that's going to reduce aggregate demand, increase unemployment, and to a certain degree there, we just give a hat tip to the Phillips curve. Although it's deeply flawed, I see that maybe playing out here. And in fact, I read an article this morning on how we're seeing a lot of older folks get back into the labor force that retired early because assets were way up here, but now all of a sudden that assets are down here, it's time to go back to work. And so we could see a labor shortage go to a labor surplus very quickly. But bottom line there, aggregate demand comes down, which brings down the rate of inflation, even though we still have a supply side problem. So what time frame do you see that playing out? And what do you think the Fed and maybe more importantly, the government's response to that would be?
Well, I think the main argument behind the disinflation view is based on what's going on in China. We have basically what I will call bank runs unfolding right as we speak in China. We have a public uprising against mortgage payments on home building projects that are not finished, and all of it is on top of a bizarre zero COVID policy that's still ongoing, right? So if you look beneath the surface of the Chinese economy right now, then I think the reality is extremely dark. And I think that's the main reason why we've seen this setback in right about every commodity linked to the otherwise booming real estate sector in China. Copper is down materially. I think it's in the clear bear market, that particular metal. We've seen a setback for the oil price. Even the natural gas price is lower across the globe compared to peaks. So China is the main reason. The second reason is that the Federal Reserve, I think, has done enough to bring the US into a recession. That's also what the euro-dollar futures curve is telling us. The recession is probably not unfolding today, but it may be unfolding in, say, a quarter or two from now. And we know that at least commodity markets tend to be forward-looking when it comes to recessions. So I think from like very physical goods, from that side of the equation on inflation, I basically expect deflation next year because year-over-year growth will be negative. The question is whether service prices will follow. I guess the audience in the US will know that the shelter costs or the rent of shelter has absolutely exploded this year. It's not fully reflected in the CPI yet. I expect it to be fully reflected with a time lag because that's usually what happens. So that component will stay very sticky over the course of the autumn and into next year.
Which is 35% or 33% of the total.
Yeah. But the goods inflation, that's coming down, and it's coming down hard. And that's basically the main argument behind my disinflation view now.
Okay. So and I'd like to add to that and maybe get your thoughts on it, that the Treasury curve also inverted, which most of my viewers know. But as of yesterday, the day prior, it inverted all the way, I guess, back, you would say, to the 6-month maturity. So the 6-month had a higher yield than the 10-year Treasury. And so I'm assuming that if an inversion with the 2s and 10s is bad, an inversion of the 6-month and the 10-year is even worse.
And I mean, the Federal Reserve, they run a model looking at the 3-month point versus the 10-year point. So I guess when the 3-month point is higher than the 10-year point, that could be sort of a good timing to expect the Fed to become a little bit nervous about the yield curve structure.
Yeah, absolutely. In fact, I'm not really, I'm someone, if I were to hold a Treasury, I would not want to hold one for 10 years. And that's my reason for holding it, is just to get the yield and have a positive return above and beyond inflation, because I don't think that's what's going to happen here. But I actually, in my own portfolio, and I've discussed this on the channel a couple of times, I actually took some of the dry powder and bought 1-year Treasuries. because longer term, I'm pretty bullish on commodities, just going into a long-term super cycle. But they're very, very volatile. They don't go up in a straight line. So I think if we go into a recession, there could be a buying opportunity, in which case the interest rates are most likely lower. So you could get kind of a double whammy where you get a pop on your dry powder from holding it in 1-year treasuries. So you sell early, you get the capital gain, and you parlay that into commodities. In worst case scenario, you just let them mature and collect a 3% where you'd get, 1% or whatever in a bank account.
I think that sounds like a super decent strategy. It was essentially kind of the same argument I made seen from a European standpoint, that as long as the Fed doesn't completely out hike expectations, then you're pretty good off buying a few short running bonds, maybe even 5 to 10 year bonds, and hold them for a short time span. I don't think you should hold them to maturity. I perfectly agree with that, because that will be a crappy deal if you look at it in 10 years time from now. But it may make sense with the 6, 9, 12 months horizon, as a way of reflecting the scenario that is right in front of us, with very weak growth, if not negative, and rising unemployment.
What do you think? And this is another thing I've heard Snyder talk about recently with Emil. What do you think about the fact that the 4-week yield is so far under reverse repo? So just for the viewers, theoretically, the Fed would like you to believe that the absolute lowest interest rate available would be reverse repo. So if you've got an entity out there that has excess cash and the Fed wants the interest rates through IOR to be at a certain level, well, they'll have a few basis points under that, where if you're not a bank that has an account with the Fed, let's say, and you want to lend cash, you're not going to lend it at a lower rate than you could get through reverse repo, because why would you do that when it's completely risk-free and you're getting collateral in the form of, let's say, a T-bill or something that is highly valuable. But then the 4-week treasuries themselves are trading at a premium or a much lower interest rate. And this would imply that there's that these entities would far rather have the treasuries than have their cash, quote unquote, parked at the Fed, implying that there's some sort of utilization in their balance sheet where those T-bills are superior just to having the quote unquote cash. Well, have you thought through that? And if you have, what does the fact that those T-bills are trading so much lower than reverse repo, what does that tell you?
To me, it's a clear signal that there's sort of a scarcity of collateral. We need to remember that quite a few players in the financial markets, they don't have access directly to the Federal Reserve. So the T-bill is the best high quality collateral you can have in private repurchase agreements. And I basically think that we have too few T-bills right now compared to the demand for T-bills. And that's kind of the simple explanation why it could trade below the floor that the Federal Reserve sets. Because there are players out there without access directly to that reverse repo rate. And therefore you can get T-bills trading through that bottom.
Yeah, which begs the next question is, if there's a shortage in collateral, what type of risk may that imply throughout the financial system itself?
Well, we've seen it before, haven't we? I mean, when there is a shortage of collateral, it's usually an early warning signal that there is a shortage of liquidity upcoming. And we had the best example of it, I think it was in September 2019, was that when the Federal Reserve had to restart some kind of quasi QE program as a consequence of a lack of liquidity in the system.
Yeah, and where they screwed up and bought T-bills, by the way.
Yes.
The exact thing that the system needed.
Exactly. So they actually made matters worse over time. And I guess it's a bit of a guessing game at which point the same kind of scarcity will kick in this time around. But it's certainly something that we will need to be on the watch for, because that level of liquidity has increased since the last liquidity crisis. It always does, because of more debt in the system, etc.
Or the need for liquidity is what you're saying.
Yes.
Yeah.
Yes. So, I mean, the liquidity level needs to rise year after year, given the credit system that we've created. And therefore, I don't know the exact number, but it's certainly higher than the Federal Reserve thinks.
Yeah. And this, I think that the repo fails are pretty much saying the exact same thing that delta between the 4-week yield and reverse repo is saying. Because just to explain to the audience, if you and I are involved in a repo transaction, basically I'm lending you $1 billion, you're giving me T-bills in the amount of $1 billion, and we switch back the next day, and then the borrower pays a bit of interest there. But if a repo fails, basically you and I have an agreement, but then when we go to actually settle the initial transaction, one of us backs out of the deal and says, no, I'm not doing that. And correct me if I'm wrong, but usually the lender would back out of the deal because either there's a little bit more counterparty risk than they thought, or the collateral which they were going to receive, there's something a little suspicious about it, like maybe it's been rehypothecated 20 times instead of 3 times or something like that. Am I getting that right?
Yeah, absolutely. So, I mean, the amount of times the same collateral is sort of securitized, the worse in this sense, right? So you're absolutely spot on.
Yeah. So again, guys who are watching, just the takeaway here is that when you're seeing these repo fails increase, that is a sign, most likely, that there's more counterparty risk. It's also a sign that the collateral multiplier is actually decreasing. And this, coupled with what we're seeing with the 4-week T-bill rate in reverse repo, would lead one to believe that, like Andreas was saying, that the level of liquidity needs that we have right now due to what has happened over the last 2 years are not being met. And that creates potentially systemic risk within the system.